In this short video, I'm going to cover the 5 basics of buy-to-let property investing. So if you're a brand new investor, this video is definitely for you. And if you're not, maybe just use it as a refresher. Hi, my name is Mark Lloyd. I'm co-founder of Property Master Academy and been a property investor since 2005. So first of all, what is buy-to-let? Well, buy-to-let is taking a residential property, finding someone to live in it, a tenant, so you benefit from the rental income, and you also will benefit hopefully from some capital growth over the longer term, because buy-to-let investing is about the longer term, not short term. You buy now and benefit later. So what type of properties are we talking about? Well, if you're in the big cities like London, it's probably going to be a flat or apartment, 2/3 beds. If you're in the towns and smaller cities, then they're more likely to be houses. So there'll be 2 or 3 bedroom, terraced or semi-detached properties. Those will be predominantly the majority of buy-to-let stock in this country. So we've identified a property, but how are we going to buy this? What are we looking for? Well, the first thing we're looking for is something we called BMV. Now, BMV stands for below market value. In other words, getting the property at a discount. So for example, let's say we've got this property, it's worth £100,000 and you buy it for £95,000. You've therefore got a £5,000 discount. That's below market value. That's a very simple example. Now, as a professional property investor myself, I tend to look for discounts a little bit higher than that. 15 to 20% is the kind of figures I'm looking for. But if you're just starting out, focus on getting a good deal. Don't worry about the higher percentages to begin with. They will come with time once you become more experienced. So that's the first thing you need to understand, is below market value. Secondly, how do we buy it? Are we going to be buying cash or are we going to be borrowing? Now, if we take that £100,000 property again, having £100,000 tied up in one single property, that's a lot of money anyway. How are you going to expand? Are you going to save up another £100,000, which could take you a long time, or you may have the money in the bank already. But I'm going to show you why leverage is much better. In other words, getting mortgages. So let me just show you an example first. So you've got our 100,000 and this is our property. And let's assume we buy it in a high yielding area. Let's say we're going to get £10,000 per annum in rental income. Now, because we bought this cash, we're not going to have many expenses whatsoever, but we will have probably an agent to pay, a lettings agent, and some maintenance on the property. So let's assume that's going to cost us £2,000 per annum. So we're now left with £8,000 as our net rental for the year, which equates to an 8% return on our money. And hopefully that's fairly straightforward. What if we borrow instead on a buy-to-let mortgage? Now, on a buy-to-let mortgage, you will get 75% LTV. So what that means is you can borrow 75% loan to value, or more correctly, loan to purchase price. So if we're going to assume we've got this property at a discount at 100,000, so we've got it BMV already, and now we're going to actually get mortgages. Well, 75% of £100,000 is 75,000. So that means our £100,000 can now purchase 4 properties. So if we take 3 more properties, so we've now got 4 properties, each with a £25,000 deposit in each. And the rest is on mortgages. Now, of course, the other things are still going to be the same. We've still got our £10,000 rental, so that's no different. But now we've got our mortgage cost. Now, in order to work out the mortgage costs for this purposes of this example, I'm going to use a 5% interest rate. Why? Because 2 things. One, 5% is the long-term long-term mortgage rate ever since buy-to-let was started in the UK, but also it's the default rate that is used by a lot of lenders when they're calculating how much they're prepared to lend you. So if we've got a £75,000 mortgage, times that by the 5%, that gives us a yearly payment of £3,750. Okay, so with buy-to-let mortgages, they're 99% of the time are interest only, whereas on your own home they'll generally be repayment. I've done another video on this. If you look through the library, you'll see a video on interest versus repayment mortgages. So for investment mortgages, they're generally interest only, so that's going to be our interest for the year, the £3,750. We've still got our £2,000 worth of costs here. So if we take that away from the £10,000, we're now left with £4,250 for the year. Obviously a lot less than our 8,000, but of course don't forget this is times by 4 because we've now got 4 properties. So 4 properties gives us £17,000 in income compared to the £8,000 we had here. So 4,250, what does that actually equate in terms of our return now? Well, the 4,250 we relate to the £25,000 deposit we've got in the property, because we can't relate it to the 100,000 because that was in this one we bought for cash. Now we've only got £25,000 of our own money in that property. How does that pan out? What we do is we take our £4,250, we divide that by the 25,000, which is our deposit money in the property. And by the way, for all these examples, I've excluded other costs you will have, like stamp duty and solicitor's costs, just to make the figures simple to understand. So we divide it by the 25,000 and then times by 100 to give us the percentage figure. And the percentage figure here works out at 17%. So we've gone from 8% to 17% just by taking out mortgages on these properties and allowing us to purchase 3 more properties than we would otherwise have done with just buying it cash. Now, that's step 1. Next step, we're going to look at adding value. So first of all, what do I mean by adding value? Well, we've bought that property below market value at a discount, and usually with those kind of properties, there's going to be some work to them. And that's the kind of properties you want to be looking for. You want to be looking for properties where you can add some value. So, for example, this might be a new kitchen, new bathroom, possibly an extension. And by spending the money on putting these new items in, you're going to create value in the property, or what we call forced appreciation. So if we take our £100,000 property again, and we're going to spend some money refurbishing it. Now, when you're refurbishing a property, ideally what you want to do is for every £1 that you spend, you want to equal that into at least £2 to £5. Okay, so every £1 will become £2, £3, £4, £5 worth of value. And you know, if you do some research around your area, you'll know that by putting a new kitchen in will add value to a property. New bathrooms, an additional bathroom, add an extension. These will all add value. So let's suppose we're going to do a reasonable size refurbishment on this property. Let's say £20,000. So we've got our £25,000 deposit in here, plus we've now got £20,000 spent on refurbishing the property as well. So what's the end value? Let's try and keep the figures as simple as we possibly can. So if we say that this has now added another £30,000 worth of value, so we've now got a property worth £150,000. Okay, so it's gone up in value. We've forced the appreciation. So how does things now pan out? Well, you can now do what we call the BRRR model. Buy, we've refurbished, we've rented, and now we're going to refinance. And the reason why we're going to refinance is so that we can pull out our capital, or as much as we can, to go and buy it again. So we are now going to apply to refinance at 75% of £150,000. So 75% of 150,000 is £112,500. So what that means is we can now take back out our 25,000, our initial deposit we put on the property, and we can also take out an additional £12,500, so £37,500. And bearing in mind we've spent £45,000, so we've left some money in there, £7,500. So we've got £7,500 left in the property. How does this help our returns? Well, if you remember, we've got our £10,000 of rental income. We've got our £2,000 of costs, our letting agent fee and maintenance costs. And then we've got our mortgage. So our mortgage payment, which is now on £112,500, times by the 5%. And that equals 5,625, £5,625. So that's now going to leave us with a net rental income of £2,375. Okay, now it might not sound like a lot at this stage, but what is our return? Because that's really what's the most important aspect of this. Our return, if you remember, what we do is we take the rental income, divide it by our £7,500, which is the cash that we have left in the deal, and then we times that by 100 to get our return. So how much is that? So we now have a return of 31.66% on our money. And so we've gone from 8% if we bought the house cash. If we just bought a house that didn't need much doing to it, so you just essentially rented it straight away, we then went up to 17%. Now we've added some value for some appreciation and able to extract a lot of our capital. We're now at 31.66%. So here we've now got 4 properties with the 2375. So if we take the 2375 times by 4, we now have a rental income of £9,500. So again, comparing to if buying it cash, you would have only had £8,000 net, even though you didn't have any mortgages. But you've now got 4 properties producing £9,500. However, you've also extracted quite a large amount of your money, so £37,500 from each property, will allow you to then go and do it again. So you can now buy 4 more properties. So you can see the power of leverage will allow you to accelerate your property investing journey that much quicker than if you're buying just cash. So now that turns me on to the actual mortgage element and how that's calculated. And there's something called coverage that a mortgage lender uses. So what they look for is that the mortgage payment is covered by the rentals to at least a certain percentage. Now, I'm not a mortgage broker. I can tell you the kind of percentages that I'm familiar with, but these could change over time. So generally speaking, if you're buying in your own name, which is not usually the thing done these days, it's usually in a limited company, but if you're buying your own name, then you want 150% cover. So what that means is that the mortgage payment we have here, the 5,625, must be multiplied by 150%, and as long as that figure is covered by your £10,000 rental, then they will lend you the full amount, the full 75% loan to purchase price or loan to value on the refinance. Now clearly 150% times 5,625 is definitely less than the £10,000 in rent. So that means you would be able to borrow the maximum amount. If you're buying a limited company, the percentage is a little bit less. It's 125%. Again, you can see clearly that is covered from the figures. So lastly, I just want to cover capital growth. Now, capital growth is one of those things you can't predict. But in order to get capital growth, you need to buy where people want to live and in areas where people are being attracted by jobs, so by large companies, those kind of things. So people are going to want to move there because of the jobs, and if people want to move there, that means house prices will increase because of the demand. So if we take our property again, we've now got it worth £150,000. So this is our first year. And if you recall, we paid £100,000, we spent £20,000 on the refurbishment, so we've created £30,000 of equity per property. So that's times by 4. Okay, so we've got £30,000 worth of equity, and we're going to just do one property at a time. And we've also got the rental income for that year. So we know that that is £2,375. So our profit in first year per property is £32,375, and of course, as I said, that's times by 4. This is year 1. Now, that's always going to be your best year, because that's when you force the appreciation. What we're now relying on is the market forces to push that price up even further over the coming years. Now, average property prices in the UK tend to double in value every 10 years. Some areas it's sooner than that, some areas it takes a little bit longer than that. But if we assume it's going to do that over 10 years, then I'll tell you what, let's downplay the percentages and let's just look at a growth rate of only 5% per annum. Because again, doubling in 10 years, you need a growth rate of around about 7 to 8%. So let's play that down a little bit and let's just look at, if we've got a growth rate of 5%, and what kind of effect would that have on the value of our property. So we've got a value of our property, don't forget, is the 150. And if it grows by 5% in next year, then we've now got another £7,500. Of course, we've still got the rental income. So it's another 2,375, which is going to give us £9,875 times by 4 in year 2. Then in year 3, what we've now got is a value of 157,500. But we're now going to grow that by 5%. So this times by 5% is 7,875. Of course, not forgetting our rental income, and the rental income may have gone up, but I'm just going to assume it hasn't. So we've still got our 2,375. So that means in year 3, we've now made £10,250. So you can see the pattern here. If you do this consecutively, year on, year out, this is where, by holding on to property for the long term, is when you really, really, really benefit. Clearly, if you're buying in the right area, the rents will go up over a period of time as well. So now, hopefully, that's a lot clearer on the basics of buy-to-let investing. I hope you found this video really useful. If you have, please hit the like button, subscribe to the channel, and also hit the notification bell so you know when our next videos are loaded. You'll also see coming on your screen right now some other videos that we've done that will help you in your property journey. Thanks for listening.